So if you want to start a hedge fund, the most important thing you need actually isn't some billion-dollar lightning-fast algorithmic trading model. It is, well, it's about $25,000 to pay a securities lawyer.
Yeah, that legal bill comes way before any of the glamorous trading stuff.
Exactly. So today we are taking a deep dive into an exclusive set of notes, guides, and, industry blueprints that detail the really gritty step-by-step reality of launching a hedge fund.
And this is great because we really get to dismantle that whole Hollywood stereotype of hedge funds.
Oh, absolutely. It's not just like a bunch of people shouting about stock picks in a glass boardroom, right? The core mission of this deep dive, the main theme across all our sources, is that a hedge fund is primarily a rigorous legal and business structure. It is definitely not just a trading strategy.
Right. I mean, the trading strategy is just the engine, but the legal, operational, and compliance structure, that's the entire car. And today we're going to outline exactly how that engine gets built and, legally put onto the road.
Okay, let's unpack this. Because before getting into the exciting parts like trading and raising capital, you have to understand what a hedge fund actually is on paper.
Yeah, you need the structural breakdown.
Right. So our sources break this down into a very specific dual structure. First, you have the management company, which is typically formed as an LLC that you own, and that collects your fees.
Exactly. And then you have the fund itself, which is a limited partnership, or LP. That's the actual vehicle where investors pool their money.
And your role in all this is the general partner, the GP, managing that capital. It sounds like a lot of brilliant traders think their secret sauce strategy is the actual business. But this source says if you can't explain your strategy in 2 to 3 sentences, investors will literally laugh you out of the room.
They absolutely will.
Mm-hmm.
And, well, there's a good reason for that. An overly complex strategy is actually a massive red flag for investors.
Wait, really? I would have thought complexity sounds smarter.
You'd think so, but no. Clarity equals confidence. If a manager needs 20 minutes to diagram like a convoluted web of crypto arbitrage and options overlays, the investor just sees hidden risks. They want to know your edge and your risk management rules immediately.
Right, so a 2-sentence strategy shows them exactly where the returns are coming from.
Yeah, and it's also legally and tax mandated to have this specific structure. The GP and LP setup isolates operational risk from investment risk, and it prevents double taxation.
So it's a very specific tax-efficient vault. But once you have that concise strategy, you can't just start pitching it right away, can you?
Definitely not. You have to prove it works with real money first, which leads to the phase where, honestly, like 90% of hopefuls fail.
Yes. The sources call this the show me, don't tell me phase.
It's brutal.
It really is. The absolute necessity here is a 6 to 12-month verified track record. And the sources are incredibly strict about this. No screenshots of your Robinhood app allowed.
Oh, yeah. Institutional investors will just walk away if you show them a retail brokerage app. You need professional tools.
Right, like the Interactive Brokers Trader Workstation or MetaTrader 5.
Exactly. You have to trade your own capital to generate this ungameable, professionally formatted trade data. Even just $5,000 to $20,000 is acceptable to start.
But wait, if I have a killer algorithm, why do I have to risk my own $20,000 first? Can't I just show them the back-tested data to prove it works?
What's fascinating here is that theoretical risk is entirely painless. In a simulation, a 15% drawdown doesn't cause the computer to panic and lose sleep, right?
Right, the computer doesn't get stressed out.
Exactly. But investors need to see how a manager handles actual financial loss and emotional pressure. Your heart rate spikes when real money evaporates.
So they're basically auditing your psychological discipline.
Yeah, risk control is the true product being sold here, not just big returns. A modest return with rigid risk control is worth way more to them than a simulation.
That makes total sense. So let's say you survive a year of trading your own money. You have your pristine Interactive Brokers data. Now you need the legal machinery to accept someone else's money.
And here is where the sticker shock hits.
Oh, big time. The absolute baseline cost for the legal setup is $10,000 to $25,000 or more. Hiring a securities attorney is completely non-negotiable.
You're managing private capital pools, so you have to navigate some intense federal regulations.
Right, like drafting the private placement memorandum, the PPM, and your operating agreements. Plus, the sources emphasize relying on specific exemptions under the Investment Company Act of 1940.
Yeah, the 3C1 or the 3C7 exemptions.
Right. And depending on your AUM and investor count, registering as an exempt reporting advisor, an ERA with the SEC or state entities like The Texas State Securities Board is mentioned.
It's a lot of paperwork.
It really is. This isn't a DIY weekend project. You can't just spin this up on LegalZoom.
No, absolutely not. But, that high cost buys you legitimacy. Serious investors demand it. And that money also goes towards setting up your third-party service providers.
Which are crucial, right? The sources make a huge deal out of this.
Oh, they're the adults in the room. You have the fund administrator calculating your net asset value, the prime broker physically executing the trades and holding the cash, and the auditor, usually a CPA, verifying the performance.
So the manager doesn't actually physically hold the investor's money.
Never. If a manager tries to just hold the money in a bank account and email out an Excel spreadsheet of returns, that is a massive red flag.
Because that's basically a Bernie Madoff scenario waiting to happen.
Exactly. Without those independent service providers, serious investors won't even look at you.
Okay, so you have the legal structure built, the third-party validators in place. Now, the operation needs fuel, which is capital, but getting it is, well, it's highly regulated.
Very highly regulated.
The sources outline the capital requirements. $15,000 to $30,000 for legal, $2,000 to $5,000 a month for operating costs, and ideally $25,000 to $100,000 of your own capital.
Though you can start smaller with angel investors or a friends and family fund if you need to.
Right. But raising money is highlighted as the hardest part. There is an absolute prohibition on public advertising.
Yeah, no billboards, no Facebook ads.
Exactly. You have to rely on personal networks, direct referrals, and networking at places like the SALT conference or JAMOPS.
And all that networking leads to the famous 2 and 20 fee structure.
Yes. The 2% management fee and the 20% performance fee, meaning if you manage $1 million in AUM, that 2% only gives you a base income of $20,000 a year to start.
Which is really just to keep the lights on and pay those service providers we talked about.
Right. Here's where it gets really interesting, the timeline. It completely debunks the myth of quick money.
The timeline is sobering, for sure.
It is. It's 0 to 6 months to learn and trade, 6 to 12 months to build a track record, 12 to 18 months to launch, and 18 plus months to actually raise capital. We're talking about a year and a half before you even start seriously raising outside money.
Yeah, and that timeline acts as a filter. It weeds out the tourists.
Definitely.
It forces you to build a sustainable business.
Yeah.
And, the sources do mention getting targeted education to help navigate this, like earning a CIIA, the Chartered Alternative Investment Analyst designation, or using the hedge fund group.
Right, but it's execution, not endless courses, that actually gets you the capital.
Oh, absolutely. Allocators invest in execution.
But because the timeline is so long and the legal costs are so high, people try to skip steps. And our sources explicitly outline the fatal traps.
Like starting without a track record, or raising money too early.
Or skipping the legal structures, which is just asking for jail time.
Yeah, or overcomplicating the strategy.
Right. So if the listener is looking at that $30,000 legal bill and sweating, what's the play here? Because our sources do mention one highly recommended alternative path.
The smart shortcut.
Yes,
Yeah.
the prop firm route.
If we connect this to the bigger picture, the prop firm shortcut is brilliant. You work under an existing fund or a proprietary trading firm first.
So you don't have to pay for the lawyers and the prime broker yourself.
Exactly. They already have the 3C1 legal structure and the auditors in place. You build credibility, hands-on experience, and investor trust on someone else's dime.
That is so smart. You become a consistent trader first, prove you can handle the drawdowns, and only then do you turn it into your own fund business.
Right, you prove the engine works before buying the whole car.
So just to summarize this intense journey we've outlined, you go from boiling down a complex strategy to a few sentences, to grinding out a 12-month track record with your own money. Then you drop serious cash on a PPM and SEC compliance, and finally earn the right to charge 2 and 20.
It's a total shift in identity, from solo trader to financial institution CEO.
It really is.
And, the sources focus so heavily on proving your risk management to investors over that 12-month period. It leaves us with something really interesting to think about.
Oh, what's that?
Well, if the core of a hedge fund is truly a robust legal structure and airtight risk management, rather than just a brilliant trading theory, does that mean the most successful hedge fund managers are actually just exceptional risk managers who happen to trade, rather than exceptional traders who happen to manage risk?
Man, that is a fantastic question to leave off on. Huge thanks to you for joining us on this deep dive today, and to you listening, keep asking the big questions. We'll see you next time.